Hey everyone, and welcome to this explainer. Today we're going to be unlocking what a lot of people consider the absolute master key to trading. We're talking about market traps by really mastering multi-time frame analysis. If you're completely tired of getting faked out by the market and you want to understand the true underlying narrative of what price action is actually doing, you are definitely in the right place. Today we're building a complete structured system that will, for sure, change the way you look at a price chart forever. Okay, so picture this. Have you ever been in this exact position? You find what looks like just the absolute perfect trade setup on, say, a 5-minute chart. The pattern is flawless, the timing feels exactly right, you're pumped, so you confidently jump in. At first it's going okay, but then, literally out of nowhere, the market just completely crashes against you. You're sitting there staring at the screen wondering, okay, what just went wrong? Well, you aren't alone. It is hands down the most agonizing experience for a day trader. But the hard truth? In most of these cases, the setup didn't fail because your 5-minute analysis was wrong. Actually, it failed because you missed something massively important in the larger market context. Okay, let's dive into this. The real fix for this frustrating loop is top-down analysis. Basically, it's the process of starting your chart analysis way up on the higher time frames. We're talking monthly or weekly charts, just to establish the big macro trend. Only after you have that big picture locked in do you start zooming way down into the lower time frames for precise trade execution. It's kind of like putting together a massive jigsaw puzzle, right? You wouldn't start by staring incredibly closely at one single tiny piece. You look at the picture on the box first. By starting high and working our way down, we make sure we are never trading against the true underlying intentions of the market. To make this actually useful, we can break all these timeframes down into 3 really functional tiers. The higher tier for context, the medium tier for your setups, and a lower tier for your actual execution. Now, if you're a swing trader who holds positions for days or weeks, your combo might be the weekly for context, daily for setups, and the 4-hour for execution. But if you're a day trader or a scalper looking for those quick intraday moves, you just shift this whole framework down. You'd use the daily chart for your higher context, the 1-hour chart to hunt for your setups, and then the 15-minute or 5-minute charts to actually pull the trigger. But honestly, no matter your personal trading style, this 3-tier framework is absolutely essential. All right, let's kick things off with tier 1, the macro trend, where we identify the true context of the market. When we're looking at these higher timeframes, it's kind of like looking at the market from an aeroplane flying at 30,000 feet. We're absolutely not looking for trade triggers up here. Instead, we're trying to figure out the overall directional bias, like is this market broadly bullish or bearish? We want to draw major swing points and locate those massive liquidity pools. On the flip side, down at ground level on the lower time frames, we care about immediate order flow shifts and super tight stop loss placement. The golden rule here: your lower time frame execution must always, and I mean always, align with the directional bias you establish up at 30,000 feet. You only ever want to trade in the direction of the higher time frame. So to establish that big picture context on a weekly or daily chart, we have to draw out our key levels. But not just any random levels. A truly strong market structure level has 5 distinct things going for it. First off, it should have acted as both support and resistance in the past. Second, it needs to have triggered a drastic, impulsive price movement away from it that shows heavy volume stepped in. Third, look for multiple rejections or little wick touches. Fourth, it should act as a major turning point where the broader market essentially decided the asset was overvalued or oversold. And finally, it must be recently respected, because fresh levels are always going to be way stronger than old forgotten ones. Mark these zones carefully, because when price returns to them, we are expecting a massive reaction. Moving right along, once our context is set, we step down into tier 2, spotting the trade setup by applying smart money concepts. And this brilliantly illustrates the exact moment the market kind of tips its hand. It's called a change of character, or CHOCH for short. Arguably the single most vital concept in this tier, it happens when price breaks and actually closes past a previously protected swing, high or low. Say sellers fail to protect a swing high and buyers just smash right through it. That right there is a change of character. It's screaming that there's a fundamental shift in order flow. The opposing side has totally failed to hold their structure, telling us a trend reversal isn't just a possibility, it's imminent. Okay, so practically speaking, how do we actually find a high quality zone to trade from? It's a pretty mechanical 4-step process on your medium time frame. First, you wait for that impulsive move that breaks market structure, our change of character. Second, look really closely at that impulsive move to spot a fair value gap, which is basically an empty space left behind by a rapid, imbalanced price jump. Third, mark the order block. That's the last opposing candle right before that huge move kicked off. And finally, you wait patiently for price to pull back into this zone. And hey, if you're wondering which technical indicators are actually most effective for scalping and day trading strategies like this, well, the Fibonacci retracement tool is literally a game changer here. By drawing a fib on that impulsive move, day traders find that the absolute highest probability entries sit right inside the pocket between the 61.8% and 78.6% retracement levels. That right there is your premium entry zone, which brings us down into our final approach with Tier 3, executing with precision at the micro level. To really master this micro level, you've got to wrap your head around the fractal nature of markets. What this means is that price action behaves exactly the same way, regardless of the time frame you're looking at. Because of this, a massive earth-shattering trend reversal in the daily chart doesn't just happen all at once. Actually, scratch that. It never happens all at once. It will always, without fail, begin as a tiny change of character on the 5-minute chart first. By watching these lowest time frames, right, when price is tapping into our higher time frame zones, we can catch these monumental shifts in the market at their exact inception. Bringing this all together, here is your definitive multi-time frame execution checklist. First, your higher time frame bias is totally locked in. Second, you wait for price to tap into your medium time frame order block or fair value gap. Third, and please don't skip this, use you in and wait for a lower time frame change of character on the 15-minute or 5-minute chart. All right, we've covered the technical puzzle, but now we need to pivot and talk about the hard truths, risk management and patience. So the crucial point here really all comes down to one single tiny metric, 2% to 3%. It isn't just a friendly suggestion, guys, it's a lifeline. This is the absolute golden rule of capital preservation. You literally must limit the amount of capital you risk on any single trade to just 2% or 3% of your whole account balance. Why? Because trading guarantees losing streaks. Even if you have the best top-down analysis in the world, you are going to face consecutive losses. This is exactly why over 90% of new day traders wash out. They let one bad trade completely wipe out a week of flawless top-down analysis. If you're out there risking 10% or 20% of trade, your account is going to be wiped out way before the mathematical edge of your strategy can even play out. By strictly sticking to 2% to 3%, a single loss won't totally wreck you emotionally, and it absolutely won't jeopardize your ability to take the next trade, which could be the big winner. Because, like one of our sources perfectly pointed out, trading is not black and white, and what works for one person might not work for another. You just can't blindly copy someone else's time frames or setups and expect to get rich overnight. Trading is a super personal endeavor. You've got to take this top-down framework, paper trade it, test it, and tweak it. Maybe you love the stress-free nature of a weekly, daily combo, or maybe you absolutely thrive on the fast-paced 1 hour and 5-minute action. You really just have to put in the screen time to discover your own rhythm. Which brings us to our final, and honestly, probably the toughest question of the whole explainer. Are you patient enough to let the market come to you? Let's be real. Impulsivity is the absolute destroyer of trading accounts. Top-down analysis demands waiting. You're waiting for the daily level. You're waiting for the 4-hour setup. You're waiting for the 5-minute confirmation. Mastering the charts is only half the battle. The real question is, can you sit on your hands long enough to master yourself?